We are able to get these loans closed without bank statements, without tax returns, without a whole lot of hassle. We're closing these things in 20, 25, sometimes 30 days, and we're stacking them up and doing them again.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 395. If you're in the process of buying any type of rental property right now, then you've probably noticed how much more difficult it's become to find a suitable loan and terms. Changes in key metrics such as debt service coverage, interest rates, and loan to value have had a dramatic impact on the ability to get deals done. My guest today can help explain the current lending landscape and help you understand what is necessary to find the right loan for your project. Fred SaintAmour is a former U.S. Army Ranger who now helps real estate investors and business owners of all sizes get the capital they need when they need it with the best terms possible. Fred has been a commercial loan executive with Boathouse Commercial Finance since 2010. Fred, welcome to the show.
Thanks, Brian.
There are many different types of loans and many different types of lenders. You are a very specific type of lender, and I'd like you to explain that. But first, just so our audience can track, what are the different types of lenders that they might go to in a nutshell? You can just describe it in a nutshell, and then how are you different?
Well, everyone knows the banks, whether that be your federal banks or state banks, they take in deposits and they lend it out. So I'm not a bank, I'm not a banker. And then there's credit unions that also lend. They lend out their own funds. So a lot of times they have, different, more liberal guidelines. I am a private lender. We take private funds from individuals and we lend that money out. Most of our loans we lend out, then we bundle them up and sell them on Wall Street, which replenishes the cash. But that allows us a lot more flexibility. We're not under government, so much government regulation as maybe a bank would be.
And then also just help our audience track like the types of loans that you do, because I want to kind of set the table so people understand what kind of loans we're talking about today. And then you're going to give us some good insight as to what is actually going on in the loan world.
I do what the industry calls small balance commercial. So that's loans under $5 million. And I do that on, I can do it on apartments. I do it on mixed use. I do it on multifamily. Also owner occupied businesses like maybe an auto repair place or a cleaners, retail outlets and whatnot. What I do a lot of though lately is I do commercial loans on residential properties. So you're 1 to 4 family. Typically when you're buying a 1 to 4 family, you're limited to like Fannie and Freddie type loans, which have a lot of restrictions. You can only get 8 or 10 of them. And then, how else do you grow your portfolio? So I do commercial loans on those, 1 to 4 families. Again, we bundle those and sell them off, but we're able to do 100 of them because we don't hold those loans. Those go off and are sold on Wall Street. A
year ago was very different than where we are right now. Describe the type of business you were doing a year ago and just the volume and the type of loans you were making. And then I'm going to have you compare it to what is happening currently in the market. I
have never been busier than I am today, Brian, even back when, the regular conventional rates were 3% or 2.75. And that's mainly because my main products, we don't require tax returns, W-2s, or pay stubs. As a lot of investors know, you get a lot of depreciation, you write a lot of stuff off, you go to a bank for the loan, they say they oh, well, you don't qualify, you didn't make any money last year. And you're like, well, yeah, I kind of did. I've got 20 properties. So for me, it really hasn't impacted me other than the interest rates are higher. right? So I use the income of the property to qualify loans. I don't use personal income. So when I'm using the income of the property or the rental income coming in, I use that to what we have all heard of debt ratio. We debt ratio the property. We don't debt ratio the owner of the property. So a couple of times now we've bumped up against that debt ratio limit. Like, oh well, everything else qualifies for 80% financing, but we can only do like 75% financing because we're hitting that debt ratio threshold because of the increased loan amounts.
Explain the debt ratio. When you're talking about debt ratio, it's common. It's also referred to as debt service coverage ratio or just debt coverage ratio, DCR, DSCR. They all mean the same thing, don't they? And can you explain to our audience what that actually is?
On a Fannie Freddie loan, let's start off with that. That's the debt ratio or debt to income ratio. And they look at a person's debt to income ratio. And they include all the mortgages, all the rent coming in, all the car payments, the lease payments, your personal house payment, credit card payments, everything like that goes into a debt ratio. And that should be under 41, 42% on a Fannie Freddie loan when you go to buy a house or finance a rental unit. So it's kind of a global debt to income ratio. What we use is we don't care about all those other debts. We look at the debt service coverage ratio of an individual property. So if you have a single family home that you're renting out for $1,200 a month, our debt service coverage ratio is 1.2, which means, to do simple math, the principal, interest, taxes, and insurance, and if there's an association, the association fees. So your principal, interest, taxes, and insurance cannot exceed $1,000. So rent is $1,200. Your principal, interest, taxes, insurance is $1,000. Then we're good with that ratio, which is 1.2. So another way to think of it might be easier. Your lease income has to be 20% more than your principal, interest, taxes, insurance, and association fees.
If your debt service is $1,000 per month, you have to be netting $1,200 in order to cover that at a 1.2 debt coverage ratio.
Right. And the neat thing about this is we don't care what your debt coverage ratio is on any of your other properties. We only care about the property that we're lending on.
You're only looking at the single asset. Debt coverage ratio is basically the ratio that shows that your investment has the ability to pay back the loan and it has 20% left over after that.
Correct.
So it's interesting, Fred, that you're saying that you've never been busier, which is kind of surprising because there's not as many deals getting done and not as much lending going on. But I'm guessing that as a private money lender, you're probably busy because a lot of the traditional lenders aren't really lending as much right now.
There's a lot of truth to that. So, I do the regular residential Fannie and Freddie type loans. I'm a licensed lender in Michigan to do those. And what we're seeing a lot more of is something called a non-QM loan. So it's like Fannie and Freddie, but it doesn't meet Fannie and Freddie guidelines enough. And an example of that is, Fannie and Freddie, they want your taxes, your W-2s, your pay stubs, and everything like that. And a lot of self-employed people who have CPAs, take a lot of write-offs and reduce their tax burden, but then it shows, very little income. So right now I'm doing a bunch of different loans for self-employed people where on their primary residence, their second homes, where I use the deposits in their business bank account or their deposits in their personal bank account to prove their income. And so it's just like a Fannie Freddie loan, except we use a different approach to calculating income. So I think before the rates went up, these people may be qualified for a Fannie Freddie loan and not have to use bank statements to prove income. And now with those higher rates, they're not qualifying. And so now I'm seeing them.
Give us an example of some of the deals that you're closing that other lenders just aren't able to close on right now?
One example is I have an experienced investor, and let me emphasize experienced investor. He's got a 589 mid score, but he's done 30 fix and flip loans in the last 3 years. So, most people, they look at that 580 score and they're like, oh, no way. But for us, when we look at things, we'd rather have an experienced fix and flipper with a 580 score that pays his bills. I mean, he's got credit cards maxed out, right, for doing fix and flips and whatever. But we'd rather have that experienced guy with maybe a lower credit than a first-time flipper with an 800 score. I mean, we kind of look at it like, which one's riskier? Well, we'll take the guy with experience because he's already learned, hard knocks and whatnot. So that's a really good one. Another product, I have a guy who he owns his own building. This is his where he runs his business out of, but he doesn't want to sell it because his city is passing the cannabis ordinance, right? So he doesn't want to sell his building because he thinks it's going to be worth a lot more because it's on Main Street and whatever. He has 2 other buildings he sold on land contract. Both are grow facilities. And then he has his personal residence, a second home. And then he has a land contract that he needs to pay off on a building that he's converting into inside self-storage, right? And, decent credit. Well, what we were able to do was we leaned, his building, we leaned the 2 grow facilities, we leaned the property that had a land contract that we had to pay off. So we blanketed all these properties to give him the cash to pay off the land contract so he didn't lose it. And so that was like 12-month money and whatnot. And we closed that loan. I think it took us 21 days. So that's another aspect that really, maybe I don't advertise enough, but we can get real creative if there's assets available. And if there's assets available, we really don't ask a whole bunch about credit or capacity to pay or anything like that. We can just lean a whole bunch of assets, give you the money you need short term, dig yourself out of a jam, and then come back through. We're working on the construction loan right now for that inside storage facility. So
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. It's interesting you can lend in the cannabis space. Is there any issue with that, with lending on buildings that are being used for cannabis production or distribution?
No, that's where banks come in because they're, that's a federal law, right? So federal banks won't do it. And then there's a problem with the cash going into banks and whatnot. But we take a look at the asset. If we like the asset, we'll lend on it. And we also have other clients in cannabis. If God forbid, and we've never had to do it, God forbid we have to take a property back, we kind of know, how to get rid of it quickly and I don't know what's the term, quickly and painlessly, I guess. So yeah, cannabis isn't a concern for us.
I love that you can get really creative, Fred, and give us an idea of what like the most creative deal you've done so far is.
I think that would be the most creative because there was a lot of moving parts and a short time crunch, and we were able to execute and save the property for the guy. And now, that's turned into a construction loan, hopefully an end loan on it. And so he's thrilled. He's thrilled. That one took some creativity to come together. A lot of times it's someone who they own a house free and clear. They need, in this case, they need cash now. We're able to do that kind of what used to be known as like a subprime. I call it a hard money loan, which means we're lending on the hard asset. That's where that term comes from, hard money. And somehow it started to become used as a synonym. No, a homonym. What is it?
Noun? I don't know. Don't ask me grammar questions. That's not my forte.
You promised me no math questions, and I promised you no grammar questions. It became synonymous with like fix and flip. But hard money for us, it's the hard asset, and you need it. So,
how do you first of all assess risk and then mitigate that risk when you're making a loan?
Let's start at the top tier of like a commercial loan. Let's say you have a 20-unit apartment building and you have a bunch of other properties, right? So the lowest interest rate loan that you're going to get is by providing the most information possible, right? Because we sit there and we crunch the numbers, and with the more information that you know about a project and a person and an entity and what's going on, then there's not a whole lot of questions. So that kind of reduces the risk, right? So it's kind of like buying sight unseen. Ooh, that's risky. If you're buying a building and you do an interior and exterior inspection and hire an inspection crew and get a broker price opinion plus an appraisal and all this sort of stuff, you're kind of you're collecting as much information you can to take as much risk out of the transaction as possible. So we kind of do the same thing. And so, the toughest loan to get, which has, again, inverse relationship to the interest rate, is we look at your capacity, right? Your ability to pay. And that's a global debt ratio. That's your ability to pay everything you own with all the debt that you have, right? And remember, most of my loans, we don't care about all that. This is more of your typical bank type loan. So capacity we look at capital. That's your down payment, right? And that's really what we consider your skin in the game. If, a 3% loan is a lot, a 3% down payment loan is a lot riskier than a 25% down payment loan, right? So we factor that in. Collateral, we look at the asset. We'd rather lend a single family residence in a well-kept neighborhood versus a geodesic dome out in the middle of 40 acres, right? I'd rather live in the geodesic dome on the 40 acres, but as far as an asset class, we'd rather do a 1 to 4 family or maybe an 8 unit. And then we look at credit, right? We look at your credit that factors into, and along the same lines as credit is maybe experience. So when we balance all those things together, you can get a great bank type loan. And as soon as you start stripping those things away, the loans become riskier, in our eyes riskier, and therefore the loan to value might not be as high, or the interest rate might be increased a quarter or half to offset the risk.
What do you want borrowers to know before they come to you? Like what do you wish that they would get right before they come to you with a loan that they're looking for?
A lot of investors, they look at this transaction like they look at their own house. And they're like, well, what's your rate and what are the fees and everything like that, which granted is important in both transactions, but more important in your personal mortgage. A lot of these are just business transactions. And we are able to get these loans closed without bank statements, without tax returns, without a whole lot of hassle. We're closing these things in 20, 25, sometimes 30 days, and we're stacking them up and doing them again. I have a client I met 4 years ago. He had 8 loans, 8 properties with the credit union. The credit union wouldn't lend him anymore. I did a portfolio on those. I took all the 8 properties. I pulled cash out at 75%. The interest rate was like 1.5 times higher than what he had at the Polish credit union. But he took that money, that cash out money, and he used it to buy other houses, rehab them. We'd pull the cash out of those and he'd buy more, buy, rehab, repeat. And now he's got 36. And that's 4 years later. And so if you think of this mortgage, these type of products as a tool to grow your business and partner with someone to help you through the process and grow your business, I think you'd be a lot more successful.
What is your favorite hack or app?
Not too sexy of an answer, Brian. I have a loan origination software system, which keeps me and my support staff all aligned. Customers fill out the application. We give them a document upload portal where they drag and drop whatever, information we need, authorization to release your credit report or personal financial statements, just stuff like that. And we see when those all come in, so we know when a loan's ready for credit committee and not. It's called Lending Wise, and it works fantastically for me.
How would people find out more about you or get a hold of you?
A couple ways. My email address directly to me is fred@Boathouse, just like it's spelled, boat and then house, and then a CFG for Commercial Funding Group. So fred@boathousecfg.com. Or, call, text, doesn't matter to me. My numbers, this is directly to me, 269-838-3838. 269-838-3838.
Who should call you or get in touch with you? Would it just be people buying properties in Michigan, or are you lending all over the country?
We do this program all over the country. Yep. And we actually had one in a U.S. territory too. So that was kind of cool.
People all over the world listen to this podcast so they can get a hold of you and you might be able to help them, huh?
Yeah, I'd absolutely love it.
Fred, thanks for coming on the show and talking about kind of the state of commercial lending and just lending in general right now. It's great to hear that you're so busy, and that doesn't surprise me because I think a lot of other lenders have sort of pulled back. There's a lot of fear in the market right now. And I think that you're in a unique position to be able to help people. So thank you so much for coming on the show today, sharing your wisdom and your knowledge. It's been a real pleasure.
Hey, Brian, I enjoyed it myself. Thank you.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group. And you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.